If you have ever wondered why investors pay extraordinary sums for software companies that barely turn a profit, the answer lies in understanding what SaaS actually is and why its business model produces valuations that seem disconnected from reality. SaaS, software as a service, is not just a delivery mechanism for software, it is one of the most financially powerful business models ever invented. This is why SaaS businesses are worth billions. Chapter 1. What SaaS actually is. Before SaaS software was sold like a physical product, you bought a license, installed it, and owned that version until you chose to upgrade. Microsoft sold you Office. Adobe sold you Photoshop. The transaction was complete and the relationship was largely over until the next version arrived. SaaS changed this entirely. Instead of buying software, you subscribe to it. You pay monthly or annually to access software hosted in the cloud. The company handles updates, security, and maintenance. You always have the latest version, and as long as you keep paying, the service continues. For customers, this means lower upfront costs. For businesses, it means something far more valuable: predictable recurring revenue that compounds over time. Chapter 2. The magic of recurring revenue. The fundamental reason SaaS businesses command extraordinary valuations is recurring revenue. A traditional software company sells you a $500 license, revenue recognized once. To maintain growth, it constantly needs new customers because existing ones have already paid. A SaaS company charges $50 per month. In month 1, revenue is $50. Month 2, another $50. Over a year, that single customer generates $600, more than the traditional model. Over 5 years, $3,000 from one customer acquired once. Multiply that across millions of customers, and the compounding becomes extraordinary. A SaaS business that retains its customers generates growing revenue without proportionally growing sales costs. Investors value businesses on future cash flows. Predictable recurring revenue is far lower risk than one-time transactions, and that predictability commands an enormous premium. Chapter 3. Net revenue retention. The metric separating exceptional SaaS businesses from merely good ones is net revenue retention. How much revenue from existing customers grows over time. 100% net revenue retention means existing customers pay the same amount as last year. Growth comes only from new customers. 120% net revenue retention means existing customers pay 20% more than last year. They are upgrading tiers, buying additional seats, or expanding usage. This is the Holy Grail: a business growing revenue from existing customers without acquiring anyone new. Companies like Snowflake and Datadog have consistently reported net revenue retention above 130%. Their existing customer base generates 30% more revenue every year automatically. Combined with new customer acquisition, the compounding becomes extraordinary. Chapter 4. High margins and low costs. Physical businesses have a fundamental constraint. Every additional unit sold costs money to produce. A car manufacturer selling twice as many cars needs twice as much steel and labor. SaaS businesses largely escape this. Once software is built, serving one additional customer costs almost nothing. Servers need slightly more capacity, perhaps some additional support. But these costs are tiny relative to revenue generated. This produces gross margins of 70 to 85%, far above the 30 to 50% typical of physical product businesses. As revenue grows, a larger proportion converts to profit. A SaaS business scaling from $10 million to $100 million does not need to spend $90 million to generate that additional revenue. The incremental cost of growth is far lower than the incremental revenue it creates. This operating leverage is what makes SaaS businesses extraordinarily profitable at scale. Chapter 5. Switching costs. SaaS businesses benefit from a structural advantage that makes customers remarkably difficult to lose. Switching costs. When a business adopts a SaaS product, it does not just adopt software. It integrates it into workflows, trains its team, stores critical data inside it, and builds processes around it. After 2 or 3 years, the cost of switching, in time, training, data migration, and disruption, often exceeds any savings from a cheaper alternative. This stickiness is one of the most valuable properties any business can possess. Low churn, means the recurring revenue base is stable and growing. A stable, growing revenue base justifies premium valuations. The most successful SaaS companies actively increase switching costs by adding features that deepen integration, building partner ecosystems, and storing increasingly critical customer data that cannot easily be moved elsewhere. Chapter 6. Why investors pay billions. Investors evaluating SaaS businesses often use a metric called the Rule of 40. A healthy SaaS business should have a combined revenue growth rate and profit margin equaling or exceeding 40%. A company growing at 60% annually can lose money, say negative 20% margins, and still pass. The rule acknowledges that early-stage, high-growth businesses should prioritize growth over profitability because the long-term value of that growth is enormous. This explains why investors fund SaaS companies losing money for years. They are not funding losses, they are funding the acquisition of recurring revenue that will generate cash flows for decades. Every dollar spent acquiring a customer paying $100 monthly for 10 years is an extraordinarily good investment, even if the acquisition cost seems high in year one. Chapter 7. The model that prints money. SaaS businesses are worth billions because the model creates dynamics uniquely favorable for building long-term value. Recurring revenue compounds. High margins amplify growth into profit. Switching costs protect the customer base. Net revenue retention drives growth from within existing customers. And the software has essentially zero marginal cost to distribute. The same product serves 10 customers or 10 million from the same code base. The result is a business that, once it finds product market fit and retains customers effectively, generates extraordinary returns on invested capital. Not every SaaS business achieves this. The market is crowded and competition is fierce. But the ones that do demonstrate why investors pay what look like irrational prices for companies not yet turning a profit. They are not paying for today's earnings. They are paying for the compounding machine that recurring revenue creates over time. That machine, when it works, is worth billions. The model is not magic, but the math comes close.